Joe Anderson and Al Clopine of Pure Financial Advisors have the answers to your retirement plan. This is your money, your wealth.
It is not what you earn, it's what you keep. How many of you heard of that? It is so true. A lot of you are taking on a lot of risk in your overall retirement portfolios. You're trying to build it up to create a successful retirement. But guess what? What we found is taxes will take way more from you than the stock market ever will. So why take on all that risk when you're just going to lose half of it to taxes? Stick around. Over the next half an hour, we're going to tell you exactly what you need to do to get that income to you with the least amount of tax possible. Welcome. Show's called Your Money or Wealth. My name's Joe Anderson. I'm a certified financial planner, president of Pure Financial Advisors. I'm with the big man, Big Al Clopine. He's a CPA. We'll be checking in with him in just a minute. But a lot of you are retiring. 10,000 baby boomers turning 65 every single day for the next 12 to 14 years. Most of your money is in these retirement accounts, and you have no idea what the taxes are going to be. So here, over the next half an hour, we're going to educate you on what you need to do. That is what's on my mind today. You want to see something scary? Let's take a look at this. 35% of you really understand what the taxes are going to be in your traditional retirement account. Only 31% know how much tax you're going to pay or not tax you're going to pay in your Roth IRAs. And then if you look at your RMDs, no one really knows what the heck an RMD is. It's a required minimum distribution. Most of you have no idea when you have to pull that money out. There was a survey that was done. 94% of people understand how much tax you will pay if you win the lottery, but no one knows how much money that you're going to pay in tax when you do retire. Taxes play such a key role in your success or failure in retirement. I learned this a long time ago. So I looked all over Southern California for the best CPA I could find. And guess what? I had to settle for the big man, Big Al Clopine. Alan, 94% of people understand how much, if they win the lottery, how much that's going to be taxed, but only 30% of people understand the taxation of their retirement.
Well, let's try to put some clarity to that. But so you had to settle for me. That's how you describe me, huh? Well, I guess I would say the same. I looked far and wide for a CFP. I settled for Mr. Joe Anderson. So there you go. Anyway, so on today's show, gosh, we want to talk about how to create tax-efficient income. Because here's the thing, is if you have tax-efficient income, you can spend more, you don't have to take as much risk in your portfolio, and you run less risk of running out of your money. So let's talk about how to go about this. So right off the bat is, well, you got to kind of figure out your taxable income and tax rates. Figure out what tax rate that you're in. And then take a look at what you got. Take a look at your income, your assets, where they're located. Are they all in your tax-deferred accounts, which means high tax? Do you have some tax-free? Maybe some that are subject to capital gain taxes. And then once you know that, then you put together a strategy that's going to be tax-efficient all throughout your life. No more complex than that, although the devil's in the details, Joe, and it's great. None of us want to pay a lot of taxes, but how do you go about doing it? That's what we're going to talk about today.
Right, I think a lot of times people just ignore taxes. They don't understand it. They want to shy away from it. And there's the old adage, we talked about this before, is that people think that they're going to be in a lower tax bracket in retirement. But it really depends on the characteristic of the income that you're receiving. So first thing that you have to do is really understand what tax bracket that you're in. Right, so you have to look at your tax return. I think that's the most familiar form that everyone can ever think of is your tax form, the 1040. So you look at your tax form and say, all right, well, let's see what my taxable income is. You look at line 43. That is on the second page. I think we have the tax tables here to let you know exactly what you would pay in tax, depending on what line 43 says, Al.
Well, they do. And we've got the single tax rates and the married rates. And just focus maybe on that 25% tax bracket. Notice for a single taxpayer that starts at $37,451. For married, it's $94,901. So that means, like, let's say you're single and your taxable income is $50,000. You're in the 25% bracket. But most importantly is it's only that amount that's above that $36,000 number is taxed at 25%. You still get the 10% bracket. You still get the 15% bracket. But it's important to know this marginal bracket because if you add more income or you come up with more deductions, you can figure out what the detriment will be or what the savings will be. But that's how the tax table works. But let's take a look at the tax return itself. If you go to line 43 on the tax return, this will show you what your taxable income is. And in this example, it's a little over $100,000. And this is, let's say, a married couple. So, all right, so I look at last year's 2014's 1040, page 2, line 43, $100,000. Now, we're going to go back to this tax table and figure out what bracket am I really in. And when you look at the bracket, well, sure enough, that $100,000, and for a married couple, it's going to be between $74,901 and the $151,000. So you're in the 25% bracket. So it means if you're going to get a bonus of $10,000, you're going to pay taxes on 25% of that. Or if you come up with an extra deduction, then you'll save 25% of that deduction, like a charitable deduction. And of course, don't forget state taxes as well.
So when you look at retirement income planning, it's just first of all figuring out what your goals are, right?
Sure.
How much money do you want to maintain as a lifestyle? Is it $30,000, $50,000, $200,000, whatever that number is? And then you have to determine where that income is going to come from. Is it going to come from Social Security, pensions? Do you have real estate income? Well, all of that is going to be taxed at ordinary income rates. So you can add up all of those figures, and then you look at the tax tables, and that's going to tell you, all right, well, am I in the 15, the 25, 28, and so on. So you have to start out first with the goals of saying how much money do you want to spend, and then you take a look at where your assets are held. So if they're in retirement accounts, or maybe you might have Roth IRAs, maybe you have assets outside of retirement accounts, those are all taxed differently. When we get back from the break, we'll break it down for you to show you exactly how those pools are taxed, and then come up with some different ideas for some strategies to figure out exactly how do you pull those dollars to mitigate your tax as much as possible. To help us out, we got Mr. David Cook. Dave Cook is a senior advisor at Pure Financial Advisors, good friend. He will be joining us next segment, and him and Al are going to break things down and get into some strategy on helping you out to mitigate your tax. So do not go anywhere. Show's called Your Money, Your Wealth. Good morning, everyone.
Financial's goal is to bring you quality financial planning and asset management, which starts with a free financial assessment.
Most of the time when you get something for free, it's not really a great deal. The reason we do the free assessment is because we live and die by the quality of our advice. The free assessment is so that people can understand the value in the services that we provide.
Call today for your free financial assessment.
Pure Financial Advisors, trustworthy by design.
Hi, I'm Matt Balderston, Certified Financial Planner with Pure Financial Advisors. Did you know, according to U.S. Money, the average retirement benefit as of last December was $1,282 per month?
Hey, welcome back to the program. Joe Anderson, Big Al Clopine hanging out this morning. If you're curious about how to create income with the least amount of tax possible, stick around over the next couple of minutes. We're going to bring David Cook on board and break things out a little bit more smoothly and figure out exactly what you need to do. But before we get to them, let's go to the true-false.
I should wait until I retire to convert my 401k to a Roth IRA, so I'll be in a lower tax bracket and I'll have to pay less taxes on the money. Boy, that's a good question, or that's a good true-false. And we actually had some people in the studio wondering the answer on that one, Joe. And
Yeah,
I would say it depends. It depends on a number of factors, but in general, if you're in a low enough tax bracket, even while you're working, you want to start doing conversions. But when you retire, you may be in a lower bracket and you may be able to do even a little bit more.
Right. I think you just take a look at what your tax bracket is, and then that's going to determine how much money that you want to convert. You want to get that money into the Roth IRA as fast as you can, so you don't necessarily want to wait till you retire. And Al, here's the misconception or misnomer, or whatever you want to call it, is that I will be in a significantly lower tax bracket in retirement.
Yeah,
but
that's true.
We find that that's not the case, depending on how they're classifying their income. So check this out for a second, because I think a lot of you might still think this, is that you'll be in a lower tax bracket in retirement. But then you have to look at, well, how is the income that you are creating to maintain your lifestyle taxed? So there's different pools of money that you can invest in, and they're all taxed differently. So there's a tax-free pool, right? That would be ideal. So if you start creating income from this pool, right, you pay no tax. An example here would be, let's say, a Roth IRA, such as the Roth conversion that we just talked about, or maybe municipal bonds. There's a taxable pool, All right, so this is money outside of your retirement account. So this could be stocks, bonds, mutual funds, real estate. This has a special tax treatment altogether. It's called long-term capital gains. As long as you hold it for a year, you're taxed in most cases at 15%. In some cases it could be 0, or in other cases it could be as high as 20. But it is still lower in almost all cases than this, your tax-deferred account. So that is your IRAs, your 401ks, 403bs, TSPs, KEOs, defined benefit plans, and so on. Every dollar that you pull out of these retirement accounts, $24 trillion are in these accounts, are taxed at ordinary income rates. Exactly like your paycheck, but you don't pay FICA tax. So the strategy is saying, all right, well, what is my goals? How much money do I want to create as an income? And then figure out exactly how it's taxed. Because if all of your money is coming from this pool and you're maintaining your same lifestyle, most of you might be in the same tax bracket. And if tax rates go up, right, you might be even paying more tax. So Al, let's break it down to figure out, all right, well, what are the strategies that people need to take a look at in regards to creating income with the least amount of tax?
Well, Joe, it's really important, and I think a lot of people, as they sit here watching this show, probably you've got a lot of money in tax-deferred accounts, which are taxed at the higher ordinary income rates. And so it's important that you figure out how to start getting some money into the tax-free. Roth IRAs is one way to do it. You can do contributions if you're working, $5,500 per person, or $6,500 if you're 50 and older. Or you can do conversions. You can actually convert some of your IRAs or 401ks to a Roth. Of course, you have to pay tax on what you convert, but all future growth income is 100% tax-free. But let's, I guess right now I want to get into kind of how you create this tax-free or tax-efficient income stream. So I'm really excited to introduce David Cook, CFP and Senior Advisor from Pure Financial Advisors. David, welcome aboard.
Thank you. It's great to be here.
So let me ask you this. So for our viewers that have money in a tax-deferred account, maybe a taxable account, maybe some in the tax-free, and they retire, which account should they tap first? Or what's the general advice, I guess, that most people are saying as far as what to tap first?
Well, the industry for a long time has been saying kind of defer everything. Defer, defer, defer is what we hear all the time. When the ERISA Act of 1974 established the tax treatment of these retirement accounts, at that time, the highest bracket was 70%. So it may have made sense back then to defer your taxes because likely in retirement you would be in a lower bracket. But in this case, it's not tax brackets have come down quite substantially from that same point. So if you take into consideration somebody, say a household income of $140,000, today that taxable income would be in the 25% bracket. 1970, you were paying 53%.
On similar income, inflation.
Yep. Inflation adjusted. Yep.
Yeah, wow. Yeah, and so that is the advice that most accountants, most financial planners, and most people, they're told to defer, defer, defer. And when you do that, you retire, right? Let's say you retire at 65, whatever. Maybe you defer your Social Security, maybe not, but maybe you live on your savings and you pay very little tax and you think, well, what are these guys talking about? Taxation retirement is not very high at all, but what happens after that?
Yeah, you got to be careful because a lot of times we see is people will drain all of their taxable accounts first, their cash first, and again continue to defer the retirement accounts till age 70. So we know is age 70 and a half is when you have to take your required minimum distributions, and so you're forced to start taking money. At that same time, that's generally when Social Security kicks in. So there's a high likelihood for most people you're not going to necessarily be in a lower bracket. So you want to make sure that, as Joe was just mentioning, you want to have some diversification in how you invest and where you pull money out, because that's going to give you the control of what your tax situation is throughout retirement. It's going to save you a lot more money in the long run.
And so now let's say again, you've done this, you got money in all three pools. So what is the best way to start tapping accounts?
It goes back to really understanding your tax bracket. As we talked about that line 43, knowing kind of where you're at the taxable line. And so if you've got $20,000 of room in the 15% bracket and you have Social Security coming in, and let's say you've got a little pension, but you have some room, you may want to either consider taking that money out of your retirement account to fill up that 15% bracket, either to spend or to convert in the Roth IRA. Again, keeping in mind that that money now is going to grow tax-free for the rest of your life. You no longer have a business partner on that growth like you would in your retirement account with Uncle Sam and Uncle Jerry here in California.
Yeah, and it is interesting, Dave. I mean, we talk to a lot of people, come through our offices, and the general consensus is I'm going to retire and I'm going to live off my savings, and I'm just going to defer. 70 and a half comes around, their required distributions kick in, and their tax situation is completely different. It's much higher.
Yeah, you imagine if the only dollars you have left in retirement is everything that's going to come out taxable. And when it comes to taxes, I'm a realist. You have to be kind of a realist when you plan. So if we think that taxes are likely going to go higher in the future, you're just deferring to a future kind of tax situation. And if you got to say take $10,000 to put a new roof on your house, well, you have to now adjust that cost of that new roof for federal and state taxes. So it may cost you $15,000 or $12,000 instead.
Yeah, and what's interesting with a lot of people, they're in these low brackets for several years, then a higher bracket because their required distribution kicks in, so they have to take money out of their IRA. Maybe their Social Security starts, and so they got more income, and then all of a sudden something happens, just like you said. Now, if it's a medical expense, maybe they get to deduct the medical expense, and maybe that's offsetting.
Yep.
But what if it's for a new roof, or what if it's for a trip, or what if it's for grandkids' education?
Yep, there's a lot
all
of
of that's
things,
going to be fully taxable. What tends to happen is people end up in much higher tax brackets still.
And the other side of it too is you lose deductions likely when you get into retirement. So if you've done a good job of diligently paying your house off, and so you lose your mortgage deduction, your kids are out of the house, and so now you don't have those deductions. So a lot of times retirees find themselves not itemizing anymore. So they might find themselves doing it as just a standard deduction. So you're getting kind of hit on both sides.
Yeah, so probably a good way to say this is kind of look and see where you're at in terms of what assets that you have. If you're heavily into the tax deferred, start looking at ways to bleed that out. Best way to do that might be a Roth conversion. Get more balance. And then once you have balance, then you can devise a strategy to tap different accounts over your lifetime to stay out of higher brackets.
Yeah, and you don't want to paint yourself again into that corner where every dollar you have are all in retirement accounts, especially in the years where you know you have Social Security coming in and required minimum distributions about to start.
Yeah, well said, David. I really appreciate you being here. Now, where can people go to get a little bit more information?
Sure, they can always come by our office. Pure Financial Advisors, we'll sit down with them, give them a free assessment. It's usually a 2-meeting process and kind of tell you everything you need to do, kind of get to some of this stuff figured out for you.
Fantastic. Thanks again, Dave.
Absolutely great to be here.
Joe, back to you. I think well said. I think it's getting more balance between the 3 pools that you mentioned, and then figuring out what's going to be the best strategy for you based upon what you got, what your goals are, and all of the above, what your age is and so forth.
Yeah, I think just to kind of break it down is that if you have a lot of money here, and I think that's what the guys were talking about, is that you have a lot of money in your IRAs and 401ks and any other type of retirement account. And so when you start pulling dollars from this account, right, you have to pay ordinary income tax on it. So here's been the advice for many years is keep on deferring, defer, right? Why take that money out? You're just going to have to pay taxes on it, so you're kicking the can down the road. And so people now start taking their income from this account, right? It might be cash reserves, you might have some stocks, bonds, so you're selling those assets. You're paying very little in tax, and all these retirement assets are continuing to grow. The point of the discussion is this, is that you want to make sure that you set yourself up, that you have money in each of the different areas, all right? And then come up with a solution or a strategy, because when it comes time to take money, you have different areas to pull from. Because think of it like this, if all of my money is sitting in this tax-deferred account, your IRAs for instance, right? And as inflation goes up, that means the cost of goods and services go up. And so then you have to pull more money from that overall account. As you pull more money from that account, guess what is going to happen? You're going to pay more tax. So you want to make sure that you have a strategy in place, because tax rates stair-step, as we talked about, right? There's different rates. You got a 10%, you got a 15, you got a 25, 28, and so on. So what you're trying to do is just maximize these tax brackets to say, you know what, I don't want to pay any more than 15%. Then I'm only going to pull from this retirement account to the top of that 15% tax bracket, right? I'm going to say, all right, well here, I'm going to pull, I'm going to stop right there, but I want more income. So what do? All right, well now I'm going to pull from here or here. So what I'm essentially doing is living up in these high brackets, but only paying 15% in tax. It could save you tens, if not hundreds of thousands of dollars over your lifetime if you strategize correctly. Hey, stick around. I'm going to do a case study when we get back to really dive in so you understand the impact of the right type of planning. So don't go anywhere. Show's called Your Money and It's Your Wealth. Hey, welcome back to the show. Show's called Your Money, Your Wealth. Joe Anderson, Big Al Clopine hanging out this morning. Stick around this segment. We're talking about how to create income with the least amount of tax possible. I'll break down a couple case studies for you. But before we get to that, let's go to the true-false.
To minimize my tax bill, I should liquidate my stocks held outside of my retirement accounts first when looking for income in retirement. And I guess what's being asked is, if you need income, if you're going to liquidate something, if you liquidate your assets, your stocks in your 401k, and take those out, you'll pay ordinary income tax. If you liquidate your stocks outside of your retirement accounts, it's subject to capital gain tax, and it's only the gain. Maybe you got $50,000 of stocks and it's only $10,000 of gain, so I only pay capital gains on that $10,000. So that is true. Whether that's the right answer for you or not is, and we're going to go back to last segment, it kind of depends. It depends upon your tax bracket whether that's the best strategy, but that's a true statement.
Yeah, well, I think here's the common advice, and I'll go back to this real quick, is that people will spend this down first, right, and let this defer because this is going to be a cheaper tax for you, right? But then this is what we see, is that if I take a look, all right, and this is tax rates, and this is time, all right? So people pay very little tax with that strategy, and what we see, it just spikes like this. What I want you to do is do some planning, right? So that you pay maybe a little bit more tax here to get yourself set up to save tens, if not hundreds of thousands of dollars over your lifetime or over your kid's lifetime. It's very powerful type of planning. Because here's kind of a case study real quick. If I take a look, we got an individual that has a lot of money outside a retirement account. So he's reading the financial planning books and says, all right, spend down your taxable assets first. So he's 65 years, or they're 65. They have their Social Security, so they take that, $30,000, right? Because all of their money is coming from a taxable account, maybe it's cash, return of capital, they're not paying a lot of taxes at all. They're looking, whoa, I got this deduction. Look at my taxable income. It's zero. Life is grand. Yeah, this whole thing was true that I will be in a lower tax bracket in retirement. Well, then now let's fast forward to age 70. And so now they're 70, they have to take a required distribution from their retirement account. So their Social Security is going to be the same. This is just a real simple, dumb example, but you'll get the point. Is that now they have to take a required distribution. All of that money now has to come out of their retirement accounts, okay? Now what happened to their tax bracket? They were at zero, now they're in the 25% tax world. Well, that's not really good planning. You paid very little tax in the beginning, and then it spikes up on you. So let's take a look at this. How about this? Now, it seems 65, so you have other assets to live off of, but don't let those assets defer. You might want to take your retirement accounts, put them into a Roth IRA. Now what happens here is that I'm doing a Roth conversion. Now those are tax-free dollars for me to use for the rest of my life. Then I push out my Social Security to age 70. So now at age 70, my Social Security increases. Okay, that's a good thing. My required distribution decreased because I got a lot more money into the Roth IRA. And guess what? This is the biggest thing here, is that I'm maintaining these low tax brackets throughout retirement. I'm not paying very low and spiking it up. I want to even out that tax bracket throughout my retirement. And if you live, I mean, if you have short life expectancy, just ignore this last segment. But if you plan on living a very long retirement, this is a huge deal, Al. Big, big time. It can save you a lot of money.
Yeah, there's no question about that, Joe. And again, it's just trying to get more money into the tax-free so that you don't have these spikes in taxes later on. So, Joe, why don't we spend a little bit of time on our email? I think we just have a couple minutes, but we've got a good one here from Mel in La Jolla. And Mel says, I got my money in my work retirement account that I've already paid taxes on, and as well as tax-deferred money. Can I convert part of the money to a Roth IRA without having to pay additional taxes? Great question, and we've got some new guidance here. Mel, if it's a 401k, you've got good news. You actually now, based upon a new pronouncement in September, you can take your after-tax money and put it directly to a Roth IRA without paying any tax. You can then roll the rest of yours to an IRA. If you're in some kind of traditional retirement account, though, a company retirement account, you don't necessarily have that option.
Hey, let's totally agree. That's a great strategy. I think we got time for one more, Al.
Yeah, I think so, too. And this is Julie, San Marcos. And she says, I'm in my 40s. Is it better for me to have high-earning stocks or low-turnover investments in my 401k account? What do you think, Joe?
Well, in your 40s in your 401k account, yeah. I mean, it depends on what your goals are when you're looking at retirement. So if you want to retire at age 65, you definitely want to make sure that, taxes really doesn't make a difference in your retirement account as it's growing because it all grows tax deferred. So if you have high dividend paying stocks or you have growth oriented investments, right, that is the key to make sure that that account grows. If you want more tax efficient investments, those should be held outside of your retirement account so you're not getting killed with dividends and qualified dividends or anything like that hitting on your tax return. So inside the retirement account doesn't necessarily matter because it grows tax deferred. Outside of your retirement account, that's where you got to be a little bit more sophisticated in your overall investment strategy to reduce those taxes as much as you can. Hey, if you like rock and roll, you got to join us next week because I'm telling you, are you going to rock or are you going to roll it? That's what tomorrow, not tomorrow, but next week's show is all about. Hey, thanks for tuning in. For Big Al Clopine, I'm Joe Anderson, and you just watched another phenomenal episode of Your Money, Your Wealth. Have a wonderful weekend. We'll see you next week.